On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, team. Hope everyone is well. I wanted to talk today about November, why it was such a good month for investors, what some of the reasons for that strength were, and looking ahead to just a few of those short term hurdles and things to watch that might determine whether this rally continues through the end of the year and into early next year. It was a great month for investors across the board. Whether you're in shares, whether you're in bonds, whether you're in a mixture of both, you would have really enjoyed November. World shares were up 9.3%. That's the best return in 3 years since 2020. The US S&P 500 index rallied 8.9% during the month. The local NZX 50 index posted a gain of 5.3%. So, for those two indices, the US market and the New Zealand market, those were the biggest monthly gains that we'd seen since July 2022, so more than a year ago. And it wasn't just shares that had a great month. We had conservative assets like bonds and fixed income also getting in on the action. US bonds had their best month since 1985 with a 4.5% gain. Global bonds were up 5%. That's the best month since 2008. Here at home, New Zealand government bonds, the best monthly return since 2008 as well. They were up 4.1%. And the NZX investment grade corporate bond index, which is one that I reference a lot because it's a very good proxy for what the typical private investor owns in terms of their fixed income portfolio. That index posted a 2.7% rise in November, and that's the strongest month that we've seen since that index came into being back in 2001, more than 2 decades ago. There were a few reasons for such a lucrative month, and one of them I think is simply the timing. Share markets fell quite sharply in the previous 3 months. So you had the US market and the New Zealand market both down a little more than 10% between the end of July and late October. And that coincided with interest rates hitting multi-year highs, which meant bonds and fixed income also performed poorly. Interest rates or bond yields move inversely to prices. So when interest rates and bond yields are going up, you've got fixed income and bond prices going down and vice versa. And during that period, the US 10-year Treasury yield rose to a 16-year high in early October. It hit a 16-year high 2 months ago of about 5% or just a little bit higher than that. In New Zealand, wholesale interest rates here also hit the highest levels in many years, the highest since 2010. Our 5-year swap rate hit just shy of 5.4%, which was the highest we'd seen in 13 years. So that really set the scene for a rebound in November, which isn't unusual. November has historically been the strongest month of the year. For US shares, if you look back to 1950 and you take the average return of all the different months, November has seen the highest, 1.7%. So it's typically a very strong month. But I think that underperformance in the few months leading up to November did set us up for a good performance. And the only real ingredient we needed in early November to make that happen was some friendly economic data. And we got that. Several indicators, and I'm talking about the US specifically, several indicators validated that notion of us being able to achieve an elusive soft landing in the US. And a soft landing is a term or a phrase that we use in financial markets to really describe when a central bank manages to get inflation under control without tanking the economy or without seeing unemployment rise sharply. And that's not something that's been easy to achieve in the past. It's a very difficult needle to thread. And by no means is the US out of the woods just yet. We cannot rule out the prospect of a slowdown or a recession next year, but so far, and right now, it's a case of so far, so good. So in November, we saw further progress on inflation in the US. The Federal Reserve, the US central bank, the Federal Reserve's preferred inflation measure fell further. That's what they call the core PCE, and PCE stands for personal consumption expenditures. There's lots of measures of inflation over in the US. You have the typical or the regular CPI, the Consumer Price Index, but the Fed, for a range of reasons, believes that the core PCE inflation measure is a better gauge of the true pricing pressures that are out there. So that's the one that they look at and focus on quite carefully, which means that for us following financial markets, that's the one we need to look at, because if it matters to the Fed, then it matters to us. And the annual pace of core PCE inflation slowed to 3.5%. That was in October, but it was reported in November. And that's the lowest that we've seen since April 2021. So about 2.5 years ago. Now, this is important because the most recent set of Federal Reserve forecasts, just like our Reserve Bank here in New Zealand does its monetary policy statement, and they did one last week, and we talked about that extensively because they ramped up their OCR forecasts and that. The Fed in the US does the same. They call it the SEP, Summary of Economic Projections. So it's just a set of economic and financial market projections, and they do that not every meeting, but periodically. And the most recent set had inflation using that measure, the core PCE, falling to 3.7% by the end of this year. So the fact that they're at 3.5 in October, they were at 3.7 in September, now they're down at 3.5, that means they're ahead of schedule. And 3.5 is still far too high, but that's on a year-on-year basis. Now, if we look at just the last 3 months of figures, because in the US you get monthly inflation figures, here in New Zealand you only get them pretty much quarterly. There are other things that we get that we can use monthly, but the official figures are only out quarterly. In the US you get them much more frequently monthly. So if we look at the last 3 months, then core PCE inflation is running at about 2.5%. That's something we can calculate by taking the average increase of the last 3 months and then annualizing that to sort of get a more current run rate. 2.5%, which is starting to get pretty close to the Federal Reserve's target. And that supports the view that interest rates in the US have reached a peak and that the next move will be down, which is obviously a real positive from the perspective of both bonds and shares, because the point where a central bank stops raising rates tends to correlate with the peak in bond yields. And when you look forward after those peaks in central bank interest rates, you generally get quite a prosperous period for certainly bond markets, and more often than not, equity markets. Not always, but more often than not. So at the moment, the financial markets see the Fed as having reached the top, and they believe that there is a good chance we might see some falls in policy interest rates looking ahead to next year. So all of that has got markets, put them in good spirits, and we've seen that rally. Lower gas prices have also helped with sentiment in the US, and these declines have come on the back of falling oil prices. So if you look at oil prices, they're in the low to mid 70s in terms of US crude and US dollars at the moment, and oil slumped about 6% or a little more than that during November. So it finished November at a 5-month low, the lowest since July, and it's almost 20% down from where it was in November at one point. So you've seen oil prices come down, you've seen gas prices come down. That's important for consumers, it's important for inflation. Oil is still a major component of just about everything. So that has added to sentiment and boosted things as well. Now, when you see a slowdown like that in inflation, you would typically expect that to go hand in hand with a weaker economy. But we haven't seen that yet. We might see that next year, but not so far. The US has actually remained very, very resilient. And we got an updated look at the September quarter gross domestic product GDP figures for the US last week. In the US, they come out and then they're revised, I think, 2 or 3 times. So as more data comes out, you get a better steer on how GDP actually looks. So we got one of the revisions last week, late November, for the September quarter, and that showed that the world's biggest economy, which is the US, was growing at an annualized rate of 5.2% during those 3 months. So that doesn't mean that the economy grew by 5.2% over those 3 months, but if you sort of annualize the rate of change to give you sort of a year on year notional increase, a run rate, to use another cricket analogy, that's sitting at 5.2%, and that's pretty healthy. That's not a bad rate of growth, and it certainly is better than what we thought before that. I think before these revisions, it was in the high fours. So the economy is in pretty decent shape in the US, and that's really important because that's obviously what the Fed wants. That's the holy grail for markets, is that the Fed gets this inflation under control and reduces it without causing a big economic dislocation, a big rise in unemployment, or the wheels falling off. And at the moment, that is still, I won't go as far as to say it's likely, because I think we're not out of the woods yet, but there are some signs such as these that point to that still being a viable outcome, and markets have responded to that. The backdrop isn't quite as strong as that here in New Zealand, although I would say we've exceeded expectations too. Many people would have expected us to have fallen into recession by now, but we haven't. It is true that on a per capita basis, per person, we probably have been in recession. Maybe we still are. But when you look at the country in aggregate and you include the impact of sort of the migration and other areas of strength, in aggregate, we haven't fallen into recession. And I think a lot of people would have thought we would have by now. If you'd said to a lot of economists 2 years ago, late 2023, you will have an official cash rate of 5.5%, and you'll have a central bank that is potentially talking about it even going higher, or at least staying at that level for a relatively lengthy period, and you'd still have inflation that is 5 or 6%. I think you'd have a lot of economists that would have picked us to being in a pretty ugly spot. So we have outperformed by my count. We've certainly got some challenges, but for us, like the US, not quite as much, but inflation has slowed more quickly than expected. We're sitting at 5.6. The Reserve Bank thought we'd be at 6 by now. So, lower than expected is lower than expected. That's something we should be comforted by. Business confidence has rebounded to an 8-year high. And even if you look at the own activity measures in the surveys that I watch, like the ANZ Business Survey, they're not quite as strong as that, not at an 8-year high, but certainly a 2.5-year high. So that's positive. And we're seeing some clear signs of the labour market easing. So it's not all bad here on the domestic front as well. And I think you put all of that together, and that's why you've had that buoyant performance through November. Now, looking ahead, there is lots of things for us to watch. I won't talk about all of them, but if we just touch on 2 or 3 that are coming up over the next 6 or 8 weeks, I guess next week is a pretty crucial one. The next key hurdle for global markets, or in particular the US, which is the biggest market in the world and it influences what happens everywhere else. The next hurdle for the US market is the last Federal Reserve meeting of 2023, which is next week. It's a 2-day meeting. It's usually a Tuesday and a Wednesday in the US. And at the end of that, they give you the outcome. Here's what we're doing with interest rates. Here's the new forecast set. In New Zealand, that usually comes out about sort of 7 or 8 a.m. on the Thursday. So that'll be Thursday next week. While you're having your morning coffee, you can peruse all of those documents, and you can also watch Fed Chair Jerome Powell give a press conference where he will get quizzed by lots of journalists, and a lot of the journalists over there are pretty smart and switched on, and they follow the markets pretty closely, and so he gets lots of very probing questions and is put on the spot a lot. So that will be a crucial period for markets because Mr. Powell and the Fed, I don't think they'll change their interest rate settings, but their forecasts will be very interesting, whether they sort of move closer to where markets are at. And it'll be an interesting tone that he chooses to strike because with expectations having ramped up for interest rate cuts in the US earlier than people were expecting, he'll have to sort of address that and either acknowledge that and agree with it or try and pour cold water on those hopes, like our Reserve Bank did last week. So we'll be watching that very closely. That's next week. Interestingly, about 24 hours before that, a day before that, we will get the latest batch of inflation figures. And this won't be PCE inflation that the Fed likes most, but it will be the regular consumer price index, which everyone still watches because they do tend to move sort of in similar directions and by a similar quantum. So that will be important. Beyond that, in early to mid-January, we will get the reporting season for all the big international heavyweight companies, and this will be interesting because they will have to release their latest earnings results, and those, for the most part, will cover the final 3 months of this calendar year. So this will be for the December 2023 quarter. So that will help us gauge whether earnings, revenues, profitability, dividends, margins are actually holding up well enough or growing enough to justify the rally that we've seen across financial markets. And at the moment, for the S&P 500 at least, analysts are forecasting earnings growth of about 3% for the December 2023 quarter, which would be relative to the same quarter a year ago. So it's sort of year on year, about 3%. Now that's come down over the last couple of months. It's come down to the tune of 5 or 6% from where it was. So we have seen analysts pare back their forecasts, but they're still expecting a small amount of growth. More importantly, looking ahead to 2024 in terms of the calendar year, expectations are still in the vicinity of 11 or 12% earnings growth. When you look at all of 2024 versus all of 2023, put all of those S&P 500 companies together and aggregate them, earnings growth expected to be low double digits. And that would be enough to justify share prices where they're at, or to even see them push higher if that comes to fruition. But I guess some of the more cautious strategists and investors out there would say there is still a slowdown on the cards, and there's still potentially a recession of some magnitude in the US on the cards, even a mild one. And if that's the case, you're probably not going to see 12% earnings growth, because typically in recessions you see earnings declines of some magnitude. So these are all the things that we will be watching over the short term, and they will help us build a picture for where markets will go over the coming 3, 6, and 12 months. But for the time being, markets are in very good spirits. They've been comforted by lower inflation readings combined with resilient economic growth and some pretty decent earnings releases that aren't showing huge signs of weakness, as you would expect if we were headed for a hard landing or a recession. So that's where we're at, and let's hope that December is also a solid month, and it might well be. I did mention at the start that November is the best month of the year historically. Well, guess which month is just behind it as the second best month of the year? December, this one. So that's good. And that's in terms of the average return over the last 70 or 80 odd years in the US. December is also the month that has the best hit rate for being up. 75% of the time, December is up. So it's the number one month in terms of the hit rate for being a positive month. April's number 2 and November is number 3. So let's hope that continues and the year finishes strongly for investors. All right, thanks all. We'll talk again soon.